Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is a VP of Finance at Open Door Capital, Sydney Barker. Now, prior to joining Open Door Capital, Sydney served as the corporate controller for a $250 million IT company, as well as a senior financial analyst for a large public insurance company. Her experience includes various merger acquisitions with private equity firms, ERP implementations, SEC reporting, and cash management and strategy. In addition to her corporate endeavors, Sydney also has personal investments in both multifamily apartments and mobile home parks. And so, guys, with that, it's my honor to welcome Sydney Barker to the show. Sydney, how you doing today?
Hey, great. Thanks for having me on, Kevin.
Excited to have you here. Yeah, I know that it's funny. I feel like in the virtual world, our paths has crossed. We have a lot of folks in common. We've been in the industry for quite a number of years. We both love mobile home parks, and so lot of common alliances there. And would love to, this is the first time we're actually ever meeting. I don't think we've ever met for any conferences. First time that we're talking, so I'm excited to have you
Right.
here and really dive into what it is you do, kind of your background, but then also we can talk about mobile home parks. I'm very passionate about mobile home parks, which is kind of goofy to say, but I love mobile home parks. I know that you do as well. And so I'm sure we'll have some good conversation revolving around that. But, I think first and foremost, Sydney, what I'd love for you to do, if you could, I gave you just that really brief introduction. If you could maybe take a few moments and tell us a little bit more about you, your background, and then also how you found your way into the world of mobile home parks.
Yeah, that intro seems like a lifetime away. I swear, like every month with ODC feels like a year. So, um, yeah. So so that's I guess my work background. I'm finance and accounting. That's my background. Love numbers. Love mobile home parks. Yeah, I just got the bug from mobile home parks a few years ago and just decided to jump head in and just figure out how to do it. And I bought my first deal about 3 years ago, and I still have it today. And yeah, I ended up meeting Brian Murray a couple years ago up at a conference, and I guess he had heard me on like my first podcast that I did, which I sounded like a complete idiot on. And so we met there, and a couple of months later, he's like, "Hey, are you interested in maybe helping us out?" And the rest is history. I've been with Open Door now for 2 years, and we're a vertically integrated company. So we do our own property management, our own asset management, and I'm mostly on the management side of the house, managing. We've got about 5,000 mobile home units right now.
Mm-hmm. Okay, fantastic. And so, backing up a little bit, obviously you've got a finance background, and you kind of compile that with I love numbers, but I also love mobile home parks. And so, tell me about mobile home parks. I mean, it's not necessarily as much of an oddball investment as it maybe was considered, 7 to 10 years ago. I bought my first park back in 2011, and so it seems like a lifetime ago. And back then, it was if you didn't know, you didn't know. It was kind of like just good old boys network,
Yeah.
and there was a ton of people that made a lot of money in the mobile home park space, but it surely wasn't considered by the likes of large private institutional players or public institutional groups and private equity firms and such. And so, banks didn't understand the asset class, and it wasn't a desirable asset class. Again, like either you knew or you didn't know. And we knew back then, but now everyone knows about it, right? It's
Yeah.
not so much of a secret anymore. But how did you come across it? What ultimately drove you down the path of mobile home parks when there's a litany of other options out there. You're probably one of the most common is, just traditional multifamily investments. But again, there's a number of other types of asset classes that are available. So what drove you towards mobile home parks?
Probably something it was a random thought. I was at a conference, my first investing conference, when I decided to pivot to being an investor. And like you said, everyone's hot on multifamily and apartments, and
Mhm.
I like multifamily and apartments just like everybody does. But it really was the rebel in me that's like, well, if everyone's going to do that, then I want to do, you know mobile home parks, which I consider to be multifamily.
It is.
It really is.
Yeah.
And I swear I've argued with so many people over that. I'm like, it is multifamily. But yeah, I mean, I saw the writing on the wall with affordable housing. It was just really clear to me. But I think it was the thought in my mind. I mean, I remember sitting in that chair and I was like, mobile home parks are so not sexy. That was exactly what I said to myself. And so I was thinking there's not going to be as much competition. So that was my initial thought. And I just went full force with that thought. So it's kind of silly. But then I started to realize like, it's not just about it being affordable housing, which is necessary, but it's an asset class where you can get really creative. I feel like you can be a lot more creative with this asset class than you can with like apartments.
Can you
Um,
elaborate on what you mean by that?
yeah, so I mean, you can do infill. I mean, you could buy a property, you could scrape it, put new homes on. You could, to me, the selling rent to own notes, putting a home on the lot, doing a rent to own type of situation. I want to be careful, legally, because every state's different, but generally, you can do a rent to own type of note. So you can almost create like a double value with the mobile homes, which I didn't realize at the time. You get your lot rent capitalization value, but then you also can get a note valuation. The home may be worth $10,000-15,000, but if you sell it for $25,000, $30,000 on a note, you're really capturing like what I consider like a double type of value.
Mhm.
So it was things like that I realized that you can really be a lot more creative with mobile home parks.
Yeah, no, I agree with you there. And why don't we talk about the first one? I always like to kind of lay the foundation and talk about that first mobile home park investment. And I believe, if given our conversation before we start recording here, is that I think you still own it today. The first park you bought, you still own that today. So maybe tell us about that, how you found it, the opportunity you saw at hand. What was the business play with it? Was it a value add? If so, how'd you add value to it? Just give us the 10,000-foot view, if you would.
Yeah, so it took me about a year to find it. And I had obviously no idea what I was doing. I had just jumped into this space. I go a lot off my gut, what I feel. And when I saw this deal, I was like, this is it. This is exactly what I'm looking for. And one
And
of the
what was
biggest,
that? What was it exactly what you're looking for? Define that if you would. Sorry, maybe you're about to. I
um,
didn't mean to interrupt you, but
no,
please
no,
define
no,
that.
that's fine. I mean, it was low lot rent. This is back in 2019. So the lot rent was really low. I can't even remember what it was. The lot rent was low and they were not billing back for utilities. It was an owner that they owned a lot of commercial properties. They did not own any mobile home parks and they did not know how to run mobile home parks. So they weren't really capturing all of the value that they could. So the non-billing back for utilities and the low lot rent, I mean, it's just kind of a home run. I think the other thing that was interesting about it was just outside Louisville, but it was in a different state. So I
Hmm.
think that kind of threw people off. When you look at it from a map, it's still, close to a really huge city. But if you isolate it by the state, it looks like it's in the middle of nowhere. So it was just kind of a home run on so many different levels. And it's been a really awesome asset.
Did you find that, given its close proximity to Louisville, and how far away did you say it was? What was the distance?
From Louisville,
Yeah, like
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 20
drive
minutes.
20 minutes. Okay, so were you able to determine that residents that ultimately lived in that community or that were seeking to live in that community, that was a normal commute for them? Like a lot of them, had jobs or employment opportunities in Louisville. Is that mostly where they commuted to go to work?
I'm not sure if they do, but that was my assumption was that
Yeah.
it could pull from that market. So I just kind of rolled the dice on it.
Okay.
It would make sense, that would be the case.
And so, what were you guys able to do? Talk to me about the value add plan and then where you're at today. So you own it today. You ultimately made some improvements to the community. You've got rents up the market. Talk to me about the execution of the business plan. What all steps have you guys taken to extract all the value from that asset, and then what is the long-term play thereafter?
Yeah, I mean, we still haven't captured all the value there. Um, for rent bumps, this is just me personally. I do not like aggressive rent bumps. I know that we could do more. But the reason I got into this was affordable housing, and I really don't like to push rent bumps.
Mm-hmm.
So with that said, I feel like our lot rent is still low, and honestly, I'm okay with that. So we've done a really slow increase, maybe $20 a year. And it's still below market. And then we for the utility bill back, we sub-metered the units to bill back, and we're actually about to unsub-meter. This will be the first month that we're going to be switching to a RUBS
Why,
bill
why
back.
why is that? That's interesting. I've never heard of the the opposite strategy of going back from sub-metered. Would you mind elaborating?
Yeah, so the sub-meters, we went with a unit that goes off a signal, and we have to pay monthly for it for the service. And we've just found a lot of times the units freeze, they're not receiving the reads. There seems to be like a lot of administrative back and forth with trying to get the reads
Mm-hmm.
accurate, loaded into the system. And then at the end of the day, we still don't feel like we're capturing all of the bill back. For this particular property, we have really good sewer lines, water lines. And so we don't have a lot of leaks. Now, if this property kind of had some really bad infrastructure, I wouldn't feel comfortable with it. But because our lines are in really good shape, we're going to go with the RUBS strategy so that we can actually recapture everything that it's costing us. So yeah, I just felt like the cost of having the sub meters was not worth it for this particular
Mm-hmm.
property. So yeah, that's been our plan. And then we still have some vacant lots to infill.
Okay.
We're not going to do new homes at this property. It doesn't make sense for this property. So we are, sourcing some used homes, which I know, those are kind of difficult to come by these days.
At a fair price, yeah.
Yeah, at a
Once
fair
you buy a
price.
used home, it needs another 10K of rehab minimum, and the cost to move, and now you're into that 15-year-old home for $40,000 when it's all said and done, and you could have
Yeah,
you could have been probably only 10 or 15,000 away from just getting a new home at that point.
exactly. I know. So that part is a little challenging. We did have some rehabs to do when we first bought the property as well. So we rehabbed those, turned those on notes, made some money there. So that was our value add strategy. Bought it for 975, and it appraised at 2.6.
Nice, that's great.
Yeah. Yeah.
That's a lot of sweat equity built there.
Yeah.
I like it. I
Yeah.
love it. So interesting about the water meter. We had similar challenges over the years with different companies that we use to put in the more advanced meters that ultimately use a cellular signal to ping back to a main, I guess, a centralized location, a company that actually handles the readings and then bills on our behalf. And we've tried multiple companies, and we had different bad experiences with all the above, and then we've also had bad experiences with the equipment itself, just being able to withstand the colder elements and not
Yeah.
having just ongoing issues. And so yeah, we interesting. We moving forward, so we didn't necessarily go back to a rub system in some communities, but we did convert back to just like your good old standard, tried and true analog meters with like a digital pulse readout that would be on the side of the house. And so and what I found with doing that is, one of the day-to-day requirements and responsibilities of an on-site manager, and maybe it's not every day, but they should be walking the park at least once a week, should be walking, around homes. You're looking for just making sure that there's no junk, that people aren't breaking the rules, that they don't have, a car parked behind their house, or that their skirting is not falling off, or a litany of other things that are infractions. And I found that even though it's part of the maybe the day-to-day or weekly requirements of an on-site manager, most of them just don't do it. And it's really hard to have that oversight. But if they have to actually go around and read the meters, physically read them, then we know that at least once a month they are walking the entirety of the mobile home park. And so I found value there, and it doesn't
Okay,
take
that's
very long
cool.
to do so. And the old school meters, which they run, roughly $180 a piece. They're like a third of the cost of the fancy ones. Um, they last quite a long time, and they very rarely ever have issues. So anyway,
Yeah.
we've gone back in time a little bit with a lot of our communities, just because like the technology just didn't seem to stand up to all the hype that was out there. And I've talked to
Yeah.
many folks that have had a great experience with some of those digital read systems, but again, more challenges. We face way more challenges and benefits, and then decide to go against it moving forward. So, with that being
Yeah.
said, I guess my question I have for you is that's your personal property. With Open Door Capital, you guys, you have thousands of lots. What do you guys do on a company side? I mean, when you're going into a park and you're looking to submeter the water and the sewer back to the residents, what type of meters are you guys utilizing? Are you doing the old school, or are you guys going with the more advanced stuff and just dealing with the headaches associated with it?
Yeah, I mean, I think, going back to what we're talking about, it really depends on the property.
Mhm.
I find that I say that a lot because every property has its own situation. For example, my property that I have, we don't have an on-site manager and we don't
Okay,
need one,
got it.
which is great. That's not the case for every property. And we have a mixed bag at Open Door Capital as well. So I think, when it comes to sub metering, you kind of have to look at what is the situation? Do we have an on-site manager? If not, maybe the sub meter makes sense, or maybe a RUBS makes sense. So I kind of like to say, it depends. And really, I think that's where you capture the most value, is looking at it
Mhm.
from a holistic point of view and figuring out, do I want to pay somebody to go walk around and look? Or are they already there and I'm already paying them anyway and their plate's not full?
Right.
Then it kind of makes sense. But yeah, we have a really mixed bag at Open Door Capital. And a lot of times when you purchase the properties, sometimes you just inherit the system that they have, and maybe it just doesn't make sense financially to go changing it up. So I feel like that's an area that we have yet to like really dig into and address. But we've got anywhere from sub meters to RUBS, and my favorite is the direct bill from the city. Um,
Yep.
although I have found that there's some places that if even if it's direct bill, the city will come back to you and say the tenant didn't pay their bill, you got to
Yep.
pay it. So that one is a little bit of a gotcha too. So yeah,
Yeah.
building back a
We
facility is
just
a
bought a
hot
park like
topic.
that. That's funny.
Do it.
I gave us we just bought a park like that. Yeah. I mean, and I think we've owned others in the past that have been structured like that, where it's a beautiful thing that it's direct billed by the city. But if that resident gets up and skips out and it has a water bill that they just bailed on, then ultimately, before the city allows you to put a new resident at that lot and get connected, get them service, they make the park owner responsible for that bill.
Yeah,
So,
that was a surprise. We actually had that surprise at one of our properties when it was a really large bill, and they're like, "Surprise, you owe lots of money." And I was like, "Okay, we need to fix this. If you're going to make us responsible for the bill, then we want control of the bill." So we actually took back at one of our properties, took back the billing, and we paid the bill, and then we can be in control of who pays their bill. Um, so we've only done that at one property, but yeah, I don't like the gotchas on the back end.
right, right. So let's talk about switching gears a little bit. Let's talk about your role at Open Door Capital, VP of Finance. Talk to me about what that entails. What does your day to day look like? And you had mentioned earlier that your oversight is mostly on the operational side of the business. But if you would, please share some more insights.
Yeah, no, that's so exciting. I feel like, who's into titles anyway? I don't feel like you can like really capture everything. Yeah, so at Open Door Capital, we have, we've grown so quickly, and so the role of asset management has been very much a shared responsibility. So asset management to me is like very personal almost, because you feel connected with these properties. We've actually just recently hired an asset manager to kind of start consolidating those functions into one area. But right now what my role looks like is on the property side, manage all the money. So I've got a team of people. We do all the bank reconciliations, we pay all the bills, all that kind of boring accounting, bookkeeping stuff. We do accrual accounting, so we have really good month over month financial records to compare to. We do the budgets. But yeah, day to day, we do a monthly close, so that kind of takes up about 2 weeks of the month. Every month we do write-ups, we do reviews of actuals to budgets, kind of digging in, why did this happen? Let's see what else. I guess that's it. So asset management, looking at, infill strategies, capital project strategies, lender required repairs. It's usually around what are we spending our money on and why.
Mm-hmm. Yep. How long, and I don't know how many properties Open Door Capital has between its multifamily side and mobile home parks, but just when you guys are looking at, whatever your forecast was for that particular month to what actually played out, and you guys are, really digging through and finding out what happened, what went good, what went bad.
Mm-hmm.
How long of a process is that on a monthly basis to go through the entire portfolio of properties? I'm guessing it takes a few days. It'd be probably hard to cover in just a one standard day, 8-hour day.
Oh yeah, it takes multiple days.
Yeah.
So what we have been doing, and we're actually thinking recently about kind of pivoting to looking at it a little bit differently, but what we have been doing is measuring ourselves against underwriting, which I think is really important. What did we project it would do versus what is it doing now? That starts to become a little challenging on properties that you've had a couple years, 2-3 years. A lot can change in 3 years, so that's been a little bit of a something that we might pivot towards, instead of using underwriting, maybe using more of a forecasted budget for the year. I still think both are important, but we have been comparing to underwriting. So it definitely takes a long time to dive into that, but I upload the underwriting budget for what we projected, and then each month just running like a P&L to budget comparison. And since we've got 36 mobile home parks, what I do monthly now is I have like a scope. So I say, if the variance is X dollars and X percent, dig in and figure out why. Because otherwise, it will just take forever to analyze every single property. I've got a controller that, does the first review to make sure everything's accurately coded. We've got everything captured. And then from my perspective, I'm just looking for kind of those big swings. Where were the big misses that we need to dig into?
Yep. I love it. We'd love to hear from you, your perspective, going from kind of buying properties on your own to, jumping on board with a very fast growing investment firm, i.e. Open Door Capital, and just any lessons that you've learned or taken away from your time there, given working with, again, such a fast scaling business. I mean, anything that you pulled away from it that's valuable? Again, that's probably the wrong way to position that question. I mean, there's a ton of value that you pulled away from it, but what are maybe the top 3 biggest things that you feel?
I really feel like I can narrow it down to one thing.
Okay.
And it is how we operate as a team. We've got 5 core values, and usually, like, when I hear people talk about core values, I'm always like, it's so like cheesy, like who cares about that? But strangely, like our core values, we really respect them, we live by them, and we use it as our guiding light for anyone we hire, any decisions that we need to make. And it puts everybody on the same page. So that's been a really amazing thing. So having our core values, and we all just operate within that scope. We all communicate very well together. We've got a good platforms to do that, and we just have a really good culture. Everybody's positive. We have like an anti-gossip thing. Everybody likes each other, and everybody works really, really hard, and we all work together. And that's really been the secret sauce.
Okay. I love it. I love it. And talk to me about, are there any major shifts that ODC is taking or has taken here, either over the last, call it 6 months, or that's projected over the next 12 months, given the, we're kind of entering some uncertainty. We have got a lot of volatility in the capital markets. Just debt's all over the place right now. Rates are all over the place, and again, just it's a very different real estate landscape today than what it was at the same time last year. And so, have you guys made any pivots? Have you made any substantive changes internally with your operations, or anything whatsoever that reflects the changing times?
Yeah, I think one of the biggest things that we've pivoted from is what type of assets we're willing to buy. We started out, kind of aggressive with the value add turnaround properties. In Excel, that can look really sexy, like, oh, we can go in here and we can do all these things. And, a seasoned investor will tell you, reality is way different from your Excel,
Mhm.
unicorn that you think is going to happen. So, the deep value add, the really lower class turnaround properties are very difficult. And I know that, you definitely know that, Kevin. So anyway, they've been very challenging, and they take a long time to
Mhm.
turn around unless you're just 100% focused on one property. So we have pivoted towards moving towards a lot nicer properties that are more stabilized, bigger, newer homes, and less, more landlord friendly areas.
Mhm.
We've had some issues with the tenant friendly areas where we're just fighting with the city, and it's just taken up so many resources. So those have been the two pivots that we've made.
Are there any specific markets where you guys have had that issue to where it's been much more tenant friendly than landlord friendly? We've had our own experiences, some pretty big ones. Lessons learned, one being staying away from New York State, which was probably the smartest move we've ever made by selling those assets. But are there any
Yeah.
specific challenges that you guys have had, and if so, what markets were they in?
Yeah. We're kind of anti-Michigan right now.
Interesting. Okay.
Yeah, Michigan's not, we do still have some properties in Michigan, but Michigan's been challenging. Illinois, Ohio, New York, obviously California.
Hmm.
Those are kind of been our places where we haven't had the best of luck. So we're now
Yeah.
staying away from places like that.
It's interesting. I had the same feeling in New York. New York is slightly different. There's a few states throughout the US that have statewide rent control and statewide policies in place, that really protect tenants. But most states are municipality by municipality. Even states that are
Yeah.
classified as blue states, they have a lot of red pockets. Most of the time, it's just the larger city itself, that the concentration that really, gets it classified or dumped into the bucket as a blue state versus a red state. And Illinois, honestly, is one of those states that we had avoided like the plague for many years, and probably now looking back have passed on a lot of opportunities that could have otherwise been great assets to add to our portfolio. And most of the noise around Illinois and it being landlord friendly really stems out of Cook County, which is predominantly Chicago. Like that is the county that surrounds all of Chicago and a lot of the
Mhm.
suburbs there immediately outside of Chicago, and that's a massive population. And Cook County, historically has always been landlord friendly, and it's just not a great place or friendly place to own rental real estate. With all that being said, we ended up diving a little deeper on some assets that we ended up buying last year, and they have turned into some of our best performing assets, that we have in the entire portfolio. And they're not in Cook County; they're in a different county, but they're only an hour away from Chicago. And they're large assets, and the market rents have been phenomenal. The quality of residents that we've gotten have been phenomenal, and evictions haven't been challenging. The few that we've had to do haven't been challenging at all. So it's
Hmm.
interesting, but we dug pretty deep before we got too far along with those assets. Talked to a lot of park owners in different counties and really tried to get the lay of the land. Illinois also has a fairly stout manufactured housing association. They're really involved in local legislation and really trying to keep at bay any type of bills that are trying to get passed related to rent control or tenants' rights and things of that nature. And so, anyway, just throwing that out there. Not saying I
Yeah.
love Illinois, but we definitely did lump that into one bucket. But for those that are listening, if there might be a worthwhile exercise to look at opportunities that come across your desk in Illinois, and not just lump it in the bucket like I did for probably 10 years. New York, on the other hand, New York can keep its mobile home park assets and
Just throw them all away. New York, we can just throw away.
yeah. New York's a challenge. I actually
Yeah.
know Jeff Cook with Cook Properties. He's now the largest owner of mobile home parks in the state of New York. That's who he sold our assets to. So he's got his his hands on a large portion of mobile home parks in New York State. But I know that he has his own share of headaches. But it seemed like he was used to those headaches for the 25 years that he's operated in New York State and owned other types of property. So he seemed willing for the fight, not so much us.
Yeah,
But
yeah, I hear you. Yeah, it
either
does
way,
seem to be like more municipality
it
driven.
is. Yeah.
It's kind of hard to say like, cross out the entire state. I think just when it comes to like from a acquisition standpoint, you really kind of have to dig deep to figure out, is the municipality friendly?
Mm-hmm.
And that's so hard to do when you're trying to analyze
Yeah.
lots and
And it
lots
can
of deals.
change, and it can
Yeah,
change.
that's true.
So,
That's true. I think a lot of it is just the culture of the people in
mm-hmm.
that particular area. They all influence each other. And when you get
Yeah.
that culture of just thinking landlords are evil people and let's do lots of violations because they're so mean, they all kind of influence each other. And then you get this like nasty culture of not working with you, working against you, which
Yeah.
is really sad because it only hurts the tenants, you
Yeah.
know?
I agree with you. I agree with you. And I think there's speaking specifically to the mobile home park space, and I think I'm not going to call them bad actors because but there's definitely been some groups over the last couple of years that have really pushed rents. The sky high level is coming in and doubling rents day one and not really doing any improvements to the community. And
Right.
unfortunately, that sends shockwaves through the entirety of the business, and residents talk, and there's different protective associations out there that are speaking on behalf of tenants' rights and specific to manufactured housing. But the strange thing that I've always found, Sydney, when you start comparing mobile home parks with apartment complexes, or even single family rentals, right? Like it's all rental housing. Again, mobile home parks are very similar to that of traditional apartments. It's just a different type of vehicle. I mean, it's the same offering. We're offering to rent a roof, for a roof over your head, but ultimately, one's a mobile home, it's physical property, but it's in it's in the land and it's horizontal, it's not stacked on top of each other, and the other is might have three or four floors, and you've got neighbors above, below, side by
Yeah.
side. But either way, like it's rental housing. And it's fairly common in the apartment space, especially over the last couple of years, that and it's almost seems widely accepted, and there really hasn't been any pushback of landlords pushing rents 10%, 15%, 20%, sometimes even more than that in any one given year. But the world stops when that happens in the mobile home park space, right? Like, and it's all kind of affordable housing, right? We're all trying to solve that same problem of providing
Right.
affordable housing. But it seems to send a lot bigger shockwaves when it's mobile home parks versus that apartments. I don't know if you guys you guys buy both. ODC buys both. Have you guys seen that one side is much more sensitive? You got to take a more sensitive approach as far as rent increases are
Yeah.
concerned.
And I think, and yeah, we have. And I think the reason, I think maybe there's two reasons. I think the first one is because, in the mobile home parks, a lot of people own their own home,
Mm-hmm.
or they're, doing some type of method to buy the home, maybe like a rent to own or paying over time or something. And so it makes them feel more stuck. So I think that's part of the pushback. And then I think the other thing is because it's more affordable housing than apartments generally are. So they're more, I don't know, offended, they're more affected. It's more of a poor me than an apartment that
Mm-hmm.
can say, okay, well, I'm just going to go find another place. I think it's just a little bit harder for them to go find another
That's a good point.
place.
Yeah,
Yeah.
no, no, very, very valid points. Very valid points. Well, yeah, no, this has been a fun conversation, Sydney. This should have happened probably a couple years ago, but anyway, we're here now. That's all that matters. So
Yeah.
for
I
those
have a
that,
question for you, Kevin,
yeah, go
actually.
for it. Go for it.
So after all these years of experience, are you team park owned home rentals or are you team tenant owned home?
Yeah, no, I mean, I think the best way to answer that question is that in a perfect world, you would have zero park-owned home rentals, right? And but we don't live in a perfect world, and this business isn't today what it was, 20, 30, 40 years ago when the model was built around resident-owned homes. Like that's how this whole, business model came about, but it's shifted over time. And I think today, if you say that I don't want to own any park owned homes or I'm opposed to it, then you should probably just find another asset class to really focus your time, energy, and effort in, because inevitably, whether you like it or not, you're going to end up with some park owned homes. It might not be that many, but like you're even if you buy a park that's 100% tenant owned home, you're going to end up with some park owned homes. People will pass away. People will need to move. They can't sell their home. They'll abandon it, what have you. And so I mean, I think we just learned to live with it. And we've got some communities that that the park owned home component, that the rents are so strong in the area that the ROI that we're seeing on the park owned homes, even once you factor in the repairs and maintenance and turnover expenses, are substantially higher than that of what it is with just the lot renters themselves.
Yeah.
For example, like using the example of the couple of parks in Illinois that we purchased, the lot rents in that park, and we're still trying to get them off the market. But the lot rents in that park are currently, I think they're right around $400 a month. I think market's somewhere 525. But our park owned homes in there, we renovated about 30. There was about 30 vacant park homes in one of the larger communities, and they range in age from like late 70s to probably early 2000s, but average age is probably somewhere in the mid 90s. And these units over the last like year that we've been renovating them and turning them around, we're getting on average for just like your standard 3 bedroom 2 bath single wide, we're getting $1,300 a month in rent.
Wow.
And so there's a large delta there. And the economics work in that model. Our renovations are pretty stout. We do plumbing, we do electrical if it needs it, we do everything, roofing. So that way, if we know that we're strictly going to rent that unit, not do like even if we do a rent or a rent to own, we make sure that everything is covered. That way we have minimal headaches over the next, call it 3, 5, 7 years, however long we intend to hold it. But anyway, to answer your question, we're okay with it. I'm not okay with it in markets where I'll give you the other side of that spectrum. Oklahoma, there's some markets. We own some stuff in Oklahoma historically that even though lot rents might be $350 a month, and even outside of like Oklahoma City, there's like some suburbs 30, 45 minutes away that lot rents might be $350, $400 a month, but for whatever reason, rental housing is incredibly cheap. Even now, after crazy inflation we saw in the last couple of years, where we struggled with nice 3 bedroom 2 bath homes. We struggled to get $750 a month or $795 a month. Like it was nearly impossible to do. And so that delta, Sydney, is so thin that more than likely, if you turn that unit in a given year, then you're going to not come out ahead. You're going
Yeah.
to be in the red, right? Once you factor in, make ready cost and downtime, you're going to come out in the red. So I do not like park owned homes in scenarios such as that, or markets that can't support the model. So that was a very long winded answer to your question, but we're okay with them in most
Yeah,
cases.
no, I agree with with everything you said, and it's like yeah, it just depends on the property, right?
Yeah, that's it. Always
Yeah.
depends on the property. Always depends on the property. But again, it's I feel like I don't even call it a necessary evil. That's the wrong terminology to use, but like it's something you have to learn to live with to be in this business. The only downside, I think one of the big downsides with it, I've seen a lot of parks come to market that um they were a value add play where someone came in, they took a park that was 50% occupied and they brought in, called a 100 space park. And then they brought in, 50 more homes to fill in those vacant lots. So now it's 50% tenant owned home, 50% park owned home. The financing is very difficult, or I shouldn't say it's not difficult to get it financed. the quality of debt available for those types of assets is much less desirable than that of something that's got, less than 30% park-owned homes in it. So Fannie Mae and Freddie Mac won't play in the space when there's too many park-owned homes. I forget what their criteria is. I think it's either 25 or 30%.
Yeah. I think it's 20. I think it's 20 last time I
I
checked.
think they'll make exceptions in certain markets. They have certain tiered markets, and they'll make exceptions because I think that anyway. I think we got loans in the past up to maybe 25 or 30, but it was had to go through a different decision making process internally with them. But either way, there's other lenders out there that will lend on that type of asset. There's CMBS lenders, which are I just despise CMBS loans. They're just it's kind of like the last loan we'll consider, worst case scenario. And then they're non-recourse, but then you have some life companies that will look at it as well. But really, what you end up doing is getting some type of local or regional debt from a bank or a credit union. It's full recourse, which it's not the end of the world, but a lot of times the terms aren't the best. Rates might be really good, but it might have a 5-year balloon more than likely. It might have a shorter amortization to what you could get through one of the other different lenders that are out there. So again, there's all these like nuances that come along with the park-owned home model that you have to contend with. Not just the fact that you got rentals, but you've also got to contend with some of the other challenges associated with it. So
yeah, I'm hoping they'll start changing their lending criteria because I think park-owned home rentals are I really think they're a great way to go, and I feel like they're part of running this business.
yep, I agree. I agree with you. So, well, Sydney, it's been a lot of fun having you. I appreciate your time here. For those that want to learn more about you or get in contact with you, where's the best place to track you down?
I'm on Facebook. I'm on Instagram. You can look me up there. If you want to contact me directly, I'm going to give my email if that's okay.
Sure.
Sydney, SYDNEY at odcfund.com. You can check out our website, odcfund.com as well.
All righty. Good deal. Well, Sydney, thanks for joining us today. It's been a lot of fun having you.
Thank you. Appreciate it, Kevin.
All righty, guys. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.